Every dollar you borrow costs more than a dollar to pay back. And that gap? That's interest. Welcome back to MoneyMind, the show that makes personal finance actually make sense. I'm glad you're here for episode 8, because today we're tackling something you encounter every single time you swipe a credit card, take out a loan, or open a savings account. We're talking about interest rates, what they really mean, and more importantly, how they affect you. Here's the simplest definition you'll ever hear. An interest rate is the cost of borrowing money, expressed as a percentage paid over time from the borrower to the lender. Think of it like a rental fee. When you rent an apartment, you pay the landlord for using their property. When you borrow money, you pay the lender for using their money. That fee, the interest, is calculated as a percentage of the amount you borrowed, which is called the principal. So if you borrow $1,000 at a 5% annual interest rate, you'll owe $50 in interest after 1 year. That's the price tag on that loan. Let's bring this to life. You want to buy a car. You don't have the full amount, so you take out a loan. The bank lends you $20,000, but they're not doing it out of generosity. They charge you, say, 7% per year. That means over a 5-year loan, you'll pay back significantly more than you borrowed. That's the interest rate working against you as a borrower. And it compounds, meaning interest isn't just calculated on what you originally borrowed. Over time, it can be calculated on the growing balance. That's why carrying a credit card balance month to month gets expensive fast. Even a 20% rate sounds abstract until you do the math on a $3,000 balance. The takeaway for borrowers: a lower rate saves you real money. Even a 1% difference on a mortgage can translate into thousands of dollars over the life of the loan. Now flip the script. When you deposit money into a savings account or buy a bond, you become the lender. The bank borrows your money and pays you interest. That's why a high-interest savings account matters. If one account pays 0.5% and another pays 4.5%, the difference in a year on $10,000 is $50 versus $450. Same money, very different outcome. Interest rates turn your idle cash into something that grows, slowly, steadily, but meaningfully over time. One more thing worth knowing: interest rates aren't fixed forever. They move. Central banks, like the Bank of Canada, raise or lower a benchmark rate to manage the economy. When rates go up, borrowing gets more expensive, which slows spending. When rates go down, borrowing gets cheaper, which encourages it. You've probably felt this in real life. Maybe your mortgage renewal came with a higher rate than you expected, or your savings account suddenly started earning more. That's monetary policy touching your wallet directly. You don't need to understand all the machinery behind it. Just know that rates shifting changes what things cost, and it pays to pay attention. Here's your one-liner to remember. An interest rate is the price of money, and like any price, it determines whether a deal is worth it. Whether you're borrowing or saving, knowing the rate means knowing the real cost or reward. That's episode 5 of MoneyMind. Short, sharp, and hopefully something you'll actually use the next time you sign for a loan or shop for a savings account. If this clicked for you, hit subscribe. We drop a new episode every week. Next time, we're diving into currency and exchange rates, why the same $100 buys different amounts depending on where you are in the world. See you then.